So a few months on from Liberation Day, investors are, still seeing the impact. What's your view on how this is going to play out in the future?
Tariffs themselves, the US tariffs are going to be higher than historical levels. Is the future earnings trajectory in the US weaker than we think? 63% of companies actually outperform revenue expectations. UK is stagnating at the moment.
Yeah.
And I think the expectation now from the Bank of England is that inflation will stay above target.
Hello and welcome to the latest Market Insight. Today we'll be looking at what's been happening over the last month and also what the impact is in the future. Today I'm joined by Ian Hooper, who's our Progeny's Chief Investment Officer. So Ian, let's start with the bigger picture. May seemed to be a positive month for growth assets. What were the key drivers behind that?
So the main driver in May was, it's been our favourite topic of conversation, tariffs. So this time it was a risk-on month. So risk assets were in play. Equities performed well, mainly because there was a pause in the US-EU tariff discussions. And the markets took that as a read that we might avoid some really tough recessionary conditions. So that was the main reason that the growth assets performed well through the month.
We've looked at the growth asset side. What about defensive assets? What was going on in that space?
So defensive assets, the headline that dominated was the downgrading of US treasuries or the US credit rating as a country. So the US has held on to one rating of AAA from Moody's. The other credit agencies, S&P and Fitch, have downgraded from AAA some time ago. And that was removed in May. Now, it's not a real surprise, given the challenges of tariffs and the ballooning budget deficit. In fact, that was a reason that the Moody's said, look, we're going to take a notch off the credit rating because numerous administrations have not dealt with this ballooning deficit and these interest payments. And we've talked before about the problem that the US has as its debt pile gets bigger. Furnishing that debt pile becomes a drag on the economy, and that's ultimately the reason why there was a change to the credit rating. But that sort of shook the markets mid-month on the back of that news.
So we've seen the impact of that news fully play out now, or is there going to be more sort of drama behind that?
I think the market was sort of expecting it, so it did impact in the very short term. Treasury yields increase, so investors wanted to be compensated for more risk. There's more risk perceived in owning US treasuries than there was. But things then settled down at the end of the month, which tells me that the markets had already sort of started to price in that would happen.
So a few months on from Liberation Day, investors are still seeing the impact. What's your view on how this is going to play out in the future?
Okay, so I think there's a number of trends that are starting to develop around the impact of Liberation Day, and they started to embed in May. But I think as investors, we're going to have to start getting used to these trends and themes over the coming months and well into the summer. So the first theme, the first trend is the stop-start of global trade. And we look at some data from the US. So imports surged into the US into March. Then, of course, we had a big hike in tariffs with China, and they collapsed. So it's this sort of stop-start seesawing that is inevitably going to happen while we go through the Liberation Day tariff discussion. So let's get used to that. The second one is tariffs themselves. The US tariffs are going to be higher than historical levels. So right now, we think they'll be around 15%. But look where they were at the end of the Biden administration. They're around 2.5%. So economies are going to feel that headwind. And the third trend is global trade with China. So the World Bank has just warned that China has around $400 billion worth of manufactured goods that it needs to effectively find new markets for. So there are probably more themes and trends that we could pick up on, but I think they're the three that as investors will be watching closely as we go into the summer.
So it's really good to understand these trends. But what I probably want a bit more detail on is, the US and how these headwinds have affected US shares.
Well, actually, in May, US equities were the best performing developed market area. That bucks the trend we've seen from the start of 2025. And I think there's a real thing to pick up on here. This is about backward-looking data telling a really positive story in terms of results, and I'll come on to that in a second. And then this fragility of forward-looking data, and that's where the Liberation Day themes may start to impact over the coming months. So we'll just come back onto that. But let's just focus back on May. So most companies announced results, and on a blended year-on-year growth rate basis, the numbers are up about 12.4%. So the backward-looking Q1 data was strong, and then, of course, that was announced in May, and that's why we saw positive US markets. But as investors, we want to understand what's coming down the track and what's happening with markets in the near future, and that's where it starts to become not as clear. So let me give you an example. Q2, there's an expectation that earnings will drop by around 3%, earnings growth in the US. So that doesn't continue that strong Q1 trend. And that's what the market's grappling with now. Is the future earnings trajectory in the US weaker than we think? And of course, that will inevitably impact share prices and direction. And that's the thing, I think, as sort of investors, we've got the challenge of, solid looking Q1 data, but more fragile looking, forward looking data. And that is a challenge right now, I think, for investors.
So thanks for that, Ian. Looking at the US has been really insightful, but let's look a little bit closer to home. What's happening in the UK?
Okay, so I think the word I'd use for the UK is stagnating at the moment.
Okay.
So on the economic side of it, we've got easier fiscal policy. So in effect, the government's taxing companies at a higher rate, and that's supporting public spending and public sector pay increases. But the rest of the data, economic data, is pretty stagnant at the moment.
Mm-hmm.
So market expecting no more than around 1% growth in GDP this year. And you look at the monthly performance of UK markets, it was the sort of worst performing of the major developed economies in May. And that was because of some of these headwind challenges, because of the tariff challenge, inflationary challenge, and we saw UK bond yields rise. So sectors like utilities and healthcare and consumer staples were all impacted as a result of those headwinds. So I'd say the UK on the whole is in quite a plateauing place at the moment. Europe has been the place that's been performing well through the first part of this year, despite some of the sort of growth challenges. And this month it was helped by the fact that the EU and US, those trade negotiations improved, or the standoff improved. And of course, ultimately the market read that there was going to be the recessionary conditions that might follow have subsided for now. And that was the main reason for that.
So reading in the press, there's a lot about inflation risk, what's happening here in the UK?
So yeah, there is a lot of noise around the risk of inflation because of the tariffs. And we did see inflation in April and published in May. In the UK, it did increase. And I think the expectation now from the Bank of England is that inflation will stay above target, certainly into the autumn, later autumn, and then we'll start to come back down again towards the 2% target by 2027 is what the bank is expecting. I think that there's a similar thing with Europe. I think they expect it to get back towards target next year, because the growth rate in Europe is a real issue, and that the sort of lack of growth in effect will cause it to drop back down.
Earlier on, we talked about defensive assets, specifically in relation to the US, but, generally outside the US, what's been happening with kind of defensive assets?
Okay, so it was a sort of tale of two cities, two stories in May for defensive assets. So sovereign bonds, the US obviously downgrade, and in fact, any developed market nations where there's a bit of a fiscal challenge, like the UK and Japan, their yields increased and their prices fell over the month. We know why that was. But then, because it was a risk-on month, high-yield bonds actually performed better than both sovereign bonds and also investment grade or corporate bonds. Yeah. So where does high yield fit in portfolios? Well, high yield bonds are a lower credit rating bond. They're issued by companies that, say, are not as creditworthy as some of the biggest companies. And investors saw the opportunity for taking some risk in defensive asset markets. The reason they decided they want to take more risk is this overriding feeling in May that recession was less likely. So therefore, the risk appetite increased to take on high yield risk rather than corporate risk or sovereign risk. So we'll see how that develops in the coming months. But it's, high yield bonds can behave a little bit more like equities because of the nature of the bonds. So we'll see how that plays out into the rest of this year.
So I suppose in terms of risk then, high yield bonds kind of closer to equities that behave like that? Are they more close to equities on the risk scale, Ben?
Yeah, that's probably an easy way of thinking about it. So these are companies with lower credit ratings. So therefore, their correlation or their relationship with the equity price is a lot closer. Normally, when you buy a bond, it's uncorrelated. The debt is more secure than the equity. But if you think about it, you come closer together here with a high yield. Now, as investors, we want to get compensated for that risk, don't we? So they pay a much higher coupon, a much higher yield. And then we saw in May that because there was a risk on from investors, they were happy to take the extra risk and the extra coupon that you got with high yield in May. But let's just see how that plays out for the rest of this year.
So Ian, let's try and summarise that growth asset story. What are the characteristics of the shares that did really well against the ones that didn't do so well?
It would be no surprise on the back of what we've spoken about today that it was the growth momentum factor that did the best. And it was value shares that I wouldn't say did the worst. They actually also had a positive return, but they just didn't return as much as momentum and growth over May.
Thanks, Ian. That was really interesting, that summary of the factor performance. Where does that kind of leave investors now as we move into the summer period?
Okay, that's a good question. So back to some themes. Firstly, we're going to see more volatility. I think the tariff story will continue into the summer months, and the concerns about recession, the concerns about inflation, they're not going to disappear, and there will be seesawing in markets, I think, for the coming months. So in terms of investment philosophy and thinking right now, I'm going to reiterate what I've already said in previous podcasts. So remain diversified with your portfolios in terms of asset class, in terms of regions, and also focus on portfolios where there is a broadening of returns across different areas, different parts of the globe. So that the story about broadening of returns, diversification, and of course staying invested remain the key factor at this point, because as we talked about in the earnings story in the US, there is some fragility and uncertainty, and that no doubt will drive volatility in the coming months.